Hey, how's it going, guys? It is Louis, and today I'll share with you 3 great Canadian dividend stocks that are currently too cheap to be ignored. So today you'll find great Canadian stocks that are giving super high dividend yields but that are also at some massive discounts right now. Add to this, most of the companies discussed in this video are currently trading close to their 52-week low, which might represent an excellent investing opportunity for the investors. So without further ado, let's take a look at the first stock on this list. The first business on this list is the telecommunication company TELUS with the ticker T.TO. This Canadian multinational created in 1990 has lost quite a lot of value since the beginning of the year, where it has lost over 10% of its total value. But why is this happening, and will it continue on the same trend for the next couple of months? Well, as you might know, one of the biggest things that has impacted all the individuals and the companies is obviously the hike of the interest rate. And in fact, this increase of the interest rate by the Fed and the Bank of Canada is highly impacting all the dividend companies, mainly the ones that are in interest rate sensitivity sectors, notably for the utilities, the real estate investment trusts, the pipelines, and the telecommunications. It is why most of the companies found within that list comes from those sectors. On their part, TELUS is making the largest chunk of their total earnings from 3 main branches. First, you have the general consumer branch, which is representing all the global services that are offered to the overall population. After, you have the business branch, which includes great products and services offered to all kinds of businesses. And finally, you have the healthcare branch, which is providing great solutions to all the medical world. But recently, with the hike of the interest rate, we've seen that TELUS was struggling a lot financially, and it is why they've cut over 6,000 jobs a few days ago. And add to this, we've seen that in the second quarter of 2023, their net income year over year has been falling of over 61%. And this phenomenon was created by the increase of the operating expenses, which are basically the expenses linked to all the operations of the business. This includes the price of rent, equipment, inventory cost, marketing, payroll, and insurance. However, with an investor point of view of buying different stocks low and selling them pretty high, well, with a dividend of over 6% that has been growing over 7.4% year over year, it is a great opportunity in my personal opinion. And despite having some increase in their total operating expenses, you can see that they still have been able to grow their total revenue over the last 3 years, and they're still trading at a pretty fair price to earnings ratio of only 22 at the moment. And so despite having a super high debt to equity ratio of over 150%, which is mainly due to all the investments that they've made over the last couple of years, well, I still believe that TELUS is a great option for many dividend investors at the moment. Now, the second pick on my list is the Bank of Nova Scotia with the ticker BNS. This one has been down of only 1% since the beginning of 2023, but over 1 year you can see that it has been down of over 15%, and this performance has been linked to their poor past earnings performance over the last 4 quarters, where you can see that they've missed 3 times out of 4 the analyst predictions. But in fact, this isn't the only reason why this bank has been going down over the last couple of months. But to understand this downtrend, you need to be able to understand their business model and why it has a lot of potential even if it has been on a downtrend. As a bank, it obviously offers great financial services and products to their customers all around the world. This includes obviously credit cards, bank accounts, investment products, and insurance. But the particularity of this bank is its geographical locations. In fact, it has great services points in Canada and the US, as most of the Canadian banks, but it is also well represented in the Pacific Alliance countries such as Mexico, Chile, Colombia, and Peru, as well as in many different places in Asia. And in fact, BNS is well positioned in those Latin markets where they own over 15% of the total markets of Chile and Peru. The only problem with that is that compared to another big Canadian bank such as RBC that is mainly focused in developed markets, well, on their side, BNS will tend to fluctuate way more because of the instability of those countries. At the end of the day, the Bank of Nova Scotia still has over 25 million customers all around the world, and they've been able to generate over $36 billion in 2022. And now when we want to break down the total revenue of this business, it can be divided in 4 big branches. The Canadian banking branch has been down of about 10% in their total net income year over year, but they have been up of about 8% for their total revenue. The global wealth management has both seen a decrease in their total revenue and in their net income, as well as the global banking market that has seen a massive decrease of over 18% in their total net income, but an increase of about 7% in their total revenue. But surprisingly, their international bank branch has been up of about 8% in terms of the total revenue, and they have not seen any kind of growth in their total net income. So overall, as being worth over $70 billion, you can still see that this business currently worth quite a lot of money, and at the same time as an investor with a quarterly dividend of over 6.5% and a super low price to earnings ratio of only about 9, well, once again, it might be a great opportunity for many Canadian investors. And finally, for the last company on my list, I've decided to go in a sector that has been on a massive decline lately, and so I've went into the oil and the energy sector, where I've picked the company Enbridge with the ticker ENB. If you know me and if you've seen my different videos in the past, you know that Enbridge is one of my favorite energy companies in Canada, and in fact I've even decided to add more shares of it on the 4th of August. This business is focusing in the transportation of fuel and energy all around North America, and in fact it is currently North America's largest gas utility by volume and the 3rd largest one by consumer count, plus by operating the world's largest crude oil pipeline that length over 28,000 kilometers, while it transports about 30% of the total natural gas that is produced in North America, and it transports nearly 20% of the total natural gas that is used in the US. And over the last couple of years, they've also tried to adapt to tomorrow's problems in terms of the environmental crisis by developing great ways to generate renewable energy all around Canada, and now they're producing enough green energy to meet the requirements of electricity for over 965,000 homes all around the country. But as an investor, what is truly interesting about this company is that it is currently down of over 10% year over year, because the oil price is notably going down when the interest rate is going up. But since it is predicted that the interest rate won't continue to grow as much as they did in the past, well, it means that when the situation is going to stabilize, it means that the price of oil will also continue to grow back. But while waiting, you can receive some excellent 7% of quarterly dividend that is giving to their different shareholders. And the fun fact is that if you are able to purchase this stock before the 14th of August 2023, well, you're going to be able to receive the next quarterly dividend. And despite a quite high price to earnings ratio at the moment of over 40, this business has still been able to grow their total revenue over the last 3 years, and it still has a great operating margin over the last 12 months of close to 20%. But just like TELUS, the big problem of this business is their debt to equity ratio of over 120%, which means that as long as the interest rate will be that high, well, Enbridge will suffer from those, because it means that they'll have some higher expenses to pay, notably because of the interest payments that they have. Obviously, as an investor, the objective is always to buy companies when they are undervalued and to sell them when they are overvalued. And at the moment, I believe that most of the undervalued companies on the market are actually found in the sectors that we have just covered together today. Because in fact, over the last couple of months, we've seen that the dividend stocks have been harshly hit by the increase of the interest rate. But it also means that those companies currently trade at some great discount and that they might represent some great opportunities for all the dividend income investors. But on your side, if you want to invest more in high growth stocks that are currently at discount right now, well, check out the video that's gonna be right over here, and I will see you soon. Peace.